Welcome to this explainer. Okay, today we're going to do something really crucial. We are stripping away all that hyperactive modern Wall Street jargon to discover what actually builds wealth. To do this, we're anchoring ourselves in the foundational wisdom of Benjamin Graham. Specifically, we're going to focus tightly on the very first and honestly, arguably the most important lesson from his classic text. By isolating just chapter 1, we're going to figure out what it actually means to invest, and more importantly, how to stop ourselves from getting played by the market.
So let's kick things off with a pretty tough question, one that might force us to critically evaluate our own financial behaviors right out of the gate. Are you actually an investor? Or are you just a speculator in disguise? I mean, we all love to assume we're investing when we buy a stock, right? But today we are going to rigorously test that assumption because the line between building wealth and just throwing your money into the wind is incredibly thin, and identifying exactly where you stand is your absolute first step toward financial survival. Here is our roadmap for today. First up, the Wall Street identity crisis. Second, what makes a true investor? Third, the 3 speculative traps. And finally, controlling the gambler within. Let's dive right in.
All right, part 1, the Wall Street identity crisis.
The source of truth for our journey today is Benjamin Graham's absolute masterpiece, The Intelligent Investor. Graham is often remembered as the father of value investing and famously the lifelong mentor to Warren Buffett. He wrote this as the definitive manual for the general public. And in just chapter 1, he spends his time fighting back against this massive confusion of terms. He knew that if you don't know exactly what game you're playing, well, you're inevitably going to lose. You literally cannot win a game of chess if you are unknowingly playing by the rules of checkers.
You know, it's wild how Wall Street has slowly manipulated financial language over the decades to label almost everyone an investor. Just think about the historical context for a second. After the devastating market crash of 1929, common stocks were wildly regarded as purely speculative by nature. The sheer trauma of that event made people view the stock market as a dangerous casino. Even by 1948, the public still viewed these assets as wildly unsafe. But today, the culture has entirely flipped. If you download some flashy app, deposit $50, and buy a stock for 30 seconds because of a social media trend, the financial media happily and dangerously calls you an investor. To show you just how drastic this cultural shift really is, back in 1948, a Federal Reserve survey showed that over 90% of the public viewed stocks as a pure gamble. Think about that. They had just survived a massive crash, a Great Depression, and they deeply understood the terrifying, very real risks of equity markets. Fast forward to our modern era, and the word investor is thrown around so casually that it completely masks these inherent dangers. We have gamified finance to the point where the gravity of risking our hard-earned capital is just entirely lost in translation. So why the change? Well, Wall Street benefits from your speculation, not necessarily your success. There's this brilliant modern commentary by Jason Zweig, and he sharply points out that brokers actually want you to feel like a smart, sophisticated investor. Why? Because it encourages you to trade. And every single time you trade, whether you win or you lose, they collect their fees, they profit from the spread, and they monetize your activity. The whole system is designed to keep you moving. They profit from your constant activity, which is exactly why we need to reclaim the true, historically grounded definition of investing to protect ourselves. Which brings us to part 2. What makes a true investor? Way back in 1934, Graham penned this famous definition, and he defined an investment strictly by what it guarantees through discipline, not by what it hopes for in a bull market. Read it carefully. He says, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Anything that doesn't meet these exact rigid requirements is speculative. It is a binary reality. It really doesn't matter how confident you feel. If it lacks these specific elements, you are speculating. Let's break down this exact definition into 3 non-negotiable pillars that form the bedrock of intelligent wealth building. First up, you must thoroughly analyze the company. This means reading balance sheets, understanding their competitive advantage, and recognizing that you aren't just buying a blinking ticker symbol on a screen. You are buying a fractional share of a living, breathing business. Second, you must deliberately protect yourself against serious losses. Graham called this the margin of safety. You demand a discount and you never overpay, creating a cushion for when things inevitably go wrong. And third, you aspire to an adequate return. Notice he doesn't say extraordinary. You aren't chasing a miraculous get-rich-quick windfall. You are looking for a sustainable, mathematically sound, realistic gain over time. When we put them side by side, we see a stark behavioral contrast. And honestly, it forces us to ask which side our own brokerage accounts truly reflect.
Are you demanding thorough analysis, or are you just acting on a hot tip you got from a friend? Are you prioritizing the safety of your principal, or are you accepting a massive risk of total loss just for the visceral thrill of it? Are you patiently seeking an adequate return, or are you secretly hoping this particular stock is the next winning lottery ticket that's going to let you retire tomorrow? Okay, moving right along to part 3, the 3 speculative traps. Now listen, Graham is not a Puritan here. He totally admits that speculation is an unavoidable and even necessary part of the broader market ecosystem. Risk has to be assumed by someone for markets to actually function and for price discovery to occur. As he puts it, speculation is not illegal and it's not immoral. But he heavily warns us of the fatal, often really subtle errors we have to consciously avoid as individuals. Speculation only becomes truly disastrous when we engage in it without realizing we are doing it. So there are 3 specific disastrous traps people fall into without even realizing they're speculating. Trap 1, speculating when you think you are investing. This is by far the most common pitfall, basically fooling yourself into believing a speculative gamble is a sound fundamental investment just because it involves a famous company. Trap 2, speculating seriously instead of just as a minor pastime without having the proper knowledge or skill to navigate those volatile waters. And trap 3, the absolute most devastating of all, risking more money than you can afford to lose. If you fall into any of these traps, you aren't building wealth. You are simply rolling the dice in a casino where the house always has the edge. Finally, let's wrap up with part 4, controlling the gambler within. Look, human nature has a built-in gambling instinct. It just does. So the secret to success isn't pretending it doesn't exist, but rather strictly quarantining it away from your long-term wealth. You have to recognize that you're occasionally going to want to take a wild bet on a new technology or some exciting trend. Graham says that is totally fine, but you must confine it. Never mix your speculative money with your serious investment program. Set up a completely separate account for your mad money and strictly limit the amount of capital you put at risk. We're talking maybe just 1 or 2% of your total net worth. And when that speculative money is gone, you stop. You do not double down, and you certainly never raid your retirement funds to play again. So, the crucial point we want to leave you with today is to take a hard look in the mirror. Are you truly investing, or are you just feeding the Wall Street machine? Is your portfolio built on a solid foundation of rigorous business analysis and downside protection, or is it just a hopeful, scattered roll of the dice? By deeply internalizing this single-chapter strict difference between investing and speculating, you are taking the absolute most vital step toward becoming a truly intelligent investor. Really think about that the very next time you're tempted to hit that buy button.